So I'm going to show you the time frames that you can use with a higher advantage depending on key levels that you're trading. And we're also going to look at some bit of chart examples to make you clearly understand on how to enter with these time frames. Welcome once again. This is Josiah. I've been trading for 9 years since 2016. I've helped a number of students to succeed in the trading. Before going into the charts, let's look at some of the entry methods that I'm going to give you for free that you can use. So we usually have like 4, but say to give you 2 from our academy. So there's what we call shifts. Shifts happen in a reversal state. They happen during price reversing. So you have this one which is called basic shift 1, whereby price creates a lower low, lower high, lower low, lower high, lower low, then price breaks above. Then we have the second one which I can give you is that when price creates a lower low, lower high, then it comes low, then comes and creates an inside formation that breaks this lower high. So this is what we call basic shift 1. This is what we call basic shift 2. But before you be able to continue, make sure you know how to mark highs and lows. If you don't know, you can be able to go to our previous videos on YouTube to be able to understand this. So you can see this is what we call basic shift 1, basic shift 2. So how do we enter them? So we should always wait for price to take out a lower high. Then when price comes back low, it comes back to this low. On the last lower low, we buy from here, then we go high. Now this is basic shift 2. Now for this one, we shall always see price creating this inside formation, what we call an inside order block. So this is the last lower low. This is the last lower high. So most traders will always try to buy here, which is a trap. So price always come and go high, maybe fails to break the high, or even though it breaks the high, it always come back to the low. So we will always want to buy on the extreme low for this scenario. Sometimes price can do what we call direct retracement. It will just come back to the low, to this level, and we buy from that key level. It's the same as we go for the bearish ones, when price is leaving bullish to bearishness. So you can see that price creates a higher high, higher low, higher high, higher low, higher high. Then price will take out this higher low. Then price will also come and create a higher high, higher low, higher high, higher low, higher high. So price will create an inside formation, then price breaks below. So we shall be able to wait for price to come and take out this inside formation and come back to the extreme, then we can sell. This is what we call direct retracement. Then for indirect, price will retrace to this level, sell below, then come back to that level to sell. So our target is always this high. So how would it look like in form of the charts? So I have here 2 diagrams. If we notice, we have price coming, creating this higher high, higher low, higher high, then price will drop, okay? So once price drops, we shall always take our entries on this high, okay? So this is how it will look like in the candlesticks. Price will retrace to this side, then we can be able to drop. But don't worry, we're going to discuss which time frames can you play with high accuracy. To learn more of advanced concepts, make sure you subscribe on our channel, X-Men Forex, and also follow our social platforms, X-Men Forex on Instagram, Twitter, and also on Telegram. Thank you. So the same with this one, price will come and create this higher high, higher low, higher high. Then to have this inside formation, then you have this low. So if you notice, price shifted from here. It broke wick to body break. It broke from there. So expect price to retrace to this level and we'll be able to sell from here down. Are we noticing that? So we need to be able to utilize these concepts. So at the same time, we also have it here for the bullish one. Price will drop, creating a lower low, lower high, lower low. Then this is an inside formation, an inside order block. Most of the time, I don't recommend people to overbuy here. If price buys, that means time frames have agreed. So price will always come, sometimes give them. These are people who do ICT, whereby price takes out a high, they buy from an inside order block, then price comes inside lower. Or sometimes it will just come direct without wasting time. It will just come to the low just to sweep this low. Why? Because this is what we call weak liquidity pool. Price likes to take out these weak points or these weak rally-based rally that you see them from there if you do supply and demand. So we notice that price will come back to the low and respect this level, then we can buy. The same with this. This is a lower low, lower high, lower low, then price goes high, then price will be able to come back down, and we buy from this low and we continue high. So those are the ones that I wanted to give you that you can utilize. But which time frames do we need to use this? Now, for example, if you observe, let's assume this is a daily chart. This is a higher high, higher low, higher high. If you don't know how to mark higher highs, make sure you watch the first video on this YouTube channel. Be able to learn on how to mark highs and lows. For example, let's assume this is a daily time frame on this side. This is a daily chart. This is a 4 hour. This is a 1 hour. So when you're going to use 4 hour, it has a higher win rate. For example, if this is a daily higher high, as we can see, this is a daily higher low, as we can see. So when the daily candle closes above, this becomes a break-off structure. So we prefer buying price on the support of this higher low. So this means we shall have here maybe another daily candle dropping. I've just chosen daily, okay? But it can happen in all time frames. For example, this is a daily candle, which is color red dropping. One candle dropping, coming back to the higher low. So what we shall notice is that if we go to the H4 will be creating lower lows, lower highs, lower lows, lower highs inside this daily. So when H4 shifts and takes out this lower high, this will be like a basic shift 1. So we shall notice that price will come back down. Now for you to use H4 is near to daily. So that means H4 has a higher win rate. But the problem with this, if you're going to wait for H4 to take out a lower high, like from the previous chart examples I've showed you whereby you're having basic shift 1 and 2, for it to happen, keep in mind H4 will take long. But H4 has like 90% win rate, okay, if you happen to follow it. But H4 will take long, but you can be able to only trade that. You only wait for H4. How do you confirm that the daily support will hold or the daily higher low will hold? Is by seeing H4 taking out a lower high. Then we can be able to wait for price to trace back on the H4 support. Then you can buy. Okay, either with basic shift 1 or 2 or 3. What about H1? What if H1 we get a basic shift 1, but before H4 creating? Keep in mind that H1 here has like a 70. Okay. That means you've reduced your win rate. Why? Because H1 is far away from daily, but still it's a good one, okay? It is a good one. So you can decide also to buy. What about someone who's using M15? 15 minutes. 15 minutes is far away from daily. So that means you're reducing your win rate because daily and 15 minutes, they are very far because daily you skip H4, H1, then 30, then 15. Using M15, it can do work. Having basic shift 1, 2, or 3, it will happen very fast. Sometimes they will come, buy, and also sometimes they take you out because 15 minutes has a weaker signal, yet H4 has a stronger signal. So you have to be very, very mindful. You prefer using at least H4 or H1 to increase your win rate, okay? If this is weekly, you can use daily. But the problem with daily will take long, but daily has a higher win rate. Why? Because daily is near to weekly. If you use H4 is also okay, but it's like giving it 70% win rate because H4 is quite near to weekly. So you may have some bit of succession probability of price going in your way. Are we together? So make sure you apply this concept in any time frame you're comfortable with. But before you use this, make sure you first do top-down analysis. Then you pick a time frame of your choice. For example, if you trade weekly, you'd rather wait for dailies, okay? But the problem with waiting for daily will take long. If you trade H4, you'd rather wait for H1, but H1 will take long to form, to wait for a basic shift 1, 2. But keep in mind, the small time frames will be doing so. So it's up to either to wait for H1 if you're on an H4 support, or to wait for M30, which has like a 70, okay? So this one will help you to reduce the noise in the chart. But the more you use small time frames that are far away from the setup or the support key level, there's a high chance for you to hit stop loss because further time frames tend to give you weaker signals or weaker momentum. But time frames which are close to the support level, they tend to give a higher win rate or they tend to apply because they are way near to the setup time frame that you've chosen. So before you do that, you first make sure you understand higher time frame direction. In future, we shall be able to do for you that video. But learn more of these concepts, make sure you subscribe to this channel. We shall give in more insights. So thank you.